Good day, everyone. My name is Christine Joy Julina, and my topic this morning is all about accounts receivable and cash flow. Accounts receivable, or ER, is the balance of money due to a firm for goods or services delivered or used but not yet paid by customers. Accounts receivable are listed on the balance sheet as a current asset. ER is any amount of money owned by customers for purchases made on credit. When it comes to a balance sheet, any changes in accounts receivable must be reflected in cash flow. A decrease in accounts receivable implies that more cash has entered the company from customers paying off credit accounts. The amount accounts receivable decrease is added to the company's net sales. However, if accounts receivable increases, the amount of the increase must be deducted from net sales. That's because accounts receivable amount count as revenue, they are not cash. Cash flow. Cash flow is the amount of cash and cash equivalents, such as securities that a business generates or spends over a set time period. Cash flow differs from profit. Cash flow refers to the money that flows in and out of the business. Profit, however, is the money you have after deducting your business expenses from overall revenue. So let's proceed to the cash flow analysis. What is cash flow analysis? A cash flow analysis determines a company's working capital, the amount of money available to run a business operation and complete transactions. That is calculated as current assets. How do you perform a cash flow analysis? So there are three cash flow types that companies should track and analyze to determine the liquidity and solvency of the business. So first is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So, all three are included on a company's cash flow statement. In conducting a cash flow analysis, businesses correlate line items in those three cash flow categories to see where money is coming in and where it is going out. From this, they can draw a conclusion about the current state of the business. Depending on the type of the cash flow, bringing in money in is not necessarily a good thing, and spending money it is not necessarily a bad thing. Dahil nga sa sinabi nila, the more you invest, the more interest or profit you gain. So let's talk about cash flow from operating activities. So represent cash received from customers less the amount spent on operating expenses. In this bucket are annual, recurring expenses such as salaries, utilities, supplies, and rent. And the cash from investing activities reflect funds spent on fixed assets and financial instruments. These are long-term or capital investments and include property, assets in a plant, or the purchase of stock or securities of another company. So the last is cash flow from financing activities. This is a funding that comes from a company's owners, investors, and creditors. It is classified as debt, equity, and dividend transaction on the cash flow statement. So, cash flow analysis example. So, let's say company ABC has just started a business and earned revenue of $100 this year. And as per the record, their expenses are the $60. Now, in general terms, you would say company ABC has made a $100 minus the expenses of $60 is equal to $40 profit. However, in this case of company ABC, it's seen that they have a revenue of $100 this year, but they have collected the only 80 this year, and the remaining they will collect in the next year. In the case of expenses, they have only paid the US $50 this year and the remaining in the next year. So if we calculate the net cash inflow this year, it would be $80 minus $50 is equals to $30 profit. So even if company ABC has made a profit of $40 this year, its net cash inflow is $30. In cash flow analysis, we will not only include the cash related to operation, but rather we will also include expenses and incomes from investing and financing activities. 5 steps to cash flow analysis. There are a few major items to look out for trends and outliers that can tell you a lot about the health of the business. First is aim for positive cash flow. When operating income exceeds net income, is a strong indicator of a company's ability to remain solvent and sustainably grow its operation. So second, be circumspect about positive cash flow. On the other hand, positive investing cash flow and negative operating cash flow could signal problems. For example, it could indicate a company is selling off assets to pay its operating expenses, which is not always sustainable. Third is analyze your negative cash flow. When it comes to investing cash flow analysis, negative cash flow is not necessarily a bad thing. It could mean the business is making investments in property and equipment to make more products. A positive operating cash flow and a negative investing cash flow could mean the company is making money and spending it to grow. And fourth is calculate your free cash flow. What you have left after you pay for operating expenditures and capital expenditures is free cash flow. This can be used to pay down principal, interest, buy back stock, or acquire another company. And lastly, operating cash flow margin builds trust. The operating cash flow margin ratio measures cash from operating activities such as a percentage of sales revenue in a given period. A positive margin demonstrates profitability, efficiency, and earnings quality. Cash flow analysis helps your finance team better manage cash inflow and cash outflow from operations, financing activities, and investing activities, ensuring that there will be enough money to run and grow the business. Liquidity analysis and ratios. Liquidity means how quickly you can get your hands on your cash. In simpler terms, liquidity is to get your money whenever you need it. Liquidity might be your emergency savings account or the cash lying with you that you can access in case of any unforeseen happening or any financial setback. Liquidity also plays an important role as it allows you to seize opportunities. So a liquidity ratio is used to determine a company's ability to pay its short-term debt obligation. Liquidity ratio analysis the use of several ratios to determine the ability of an organization to pay its bills in a timely manner or ability to pay its short-term debt obligations. Liquidity ratio analysis helps in measuring the short-term solvency of a business. This means it helps in measuring a company's ability to meet its short-term obligation. Thus, liquidity suggests how quickly assets of a company get converted into cash. So, formula for current ratio is equal current assets over current liabilities. The first step in liquidity analysis is to calculate the company's current ratio. The current ratio shows how many times over the firm can pay its current debt obligation based on its assets. Current usually means a short-term period of less than 12 months. The formula is current ratio is equals to current assets over current liabilities. In the balance sheet, you can see the highlighted numbers. Those are the ones you use for the calculation for 2008. The calculation would be, in 2008, current ratio is equals to $708 divided by $540 is equals to 1.311 times of times. This means that the firm can meet its current short-term debt obligations 1.311 times over. In order to stay solvent, the firm must have a current ratio of at least 1.0 times, which means it can exactly meet its current debt obligation, so this firm is solvent. However, in this case, the firm is a little more liquid than that. It can meet its current debt obligation and have a little left over. If you calculate the current ratio for 2007, you will see that the current ratio was 1.182 times. So, the firm improved its liquidity in 2008, which in this case is good as it is operating with relatively low liquidity. Given the structure of the ratio, with assets on top and liabilities on the bottom, ratios above 1.0 are sought after. A ratio of 1 means that a company can exactly pay off all its current liabilities with its current assets. A ratio of less than 1, like for example 0.75 or 65, would imply that a company is not able to satisfy its current liabilities. A ratio greater than 1, like for example 2, 3, would imply that a company is able to satisfy its current bills. In fact, a ratio of 2.0 means that a company can cover its current liabilities 2 times over. A ratio of 3.0 would mean they could cover their current liabilities 3 times over, and so forth. When analyzing a company, investors and creators want to see a company with liquidity ratios above 1.0. A company with healthy liquidity ratios is more likely to be approved for credit. Next, the 3 types of liquidity ratios are current ratio, quick ratio, cash ratio. In each of the liquidity ratios, the current liabilities amount is placed in the denominator of the equation, and the liquid assets amount is placed in the numerator. So, let's tackle about the current ratio. The formula for current ratio is equals to current assets over current liabilities. The current ratio is the simplest liquidity ratio to calculate and interpret. Anyone can easily find the current assets and current liabilities line items on a company's balance sheet. Divide current assets by current liabilities and you will arrive at the current ratio. So that will be the current ratio. So next is the quick ratio. Quick ratio is equals to cash plus accounts receivables plus marketable securities over current liabilities. The quick ratio is a stricter test of liquidity than the current ratio. Both are similar in the sense that current assets is the numerator and current liabilities is the denominator. However, the quick ratio only considers the The quick ratio only considers certain current assets. It considers more liquid assets such as cash, account receivable, and marketable securities. It leaves out current assets such as inventory and prepaid expenses because the two are less liquid. So the quick ratio is more of a true test of a company's ability to cover its short-term obligations. So that will be the quick ratio. Next is the cash ratio. So the formula for the cash ratio is equals to cash plus marketable securities over current liabilities. So the cash ratio takes the test of liquidity even further. This ratio only considers a company's most liquid assets, cash and marketable securities. They are the assets that are most readily available to a company to pay short-term obligations. In terms of how strict the test of liquidity are, you can view the current ratio, quick ratio, and cash ratio as easy, medium, and hard. Since the three ratios vary by what is used in the numerator of the equation, an acceptable ratio will differ between the three. It is logical because the cash ratio only considers cash and marketable securities in the numerator, whereas the current ratio consider all current assets. Therefore, an acceptable current ratio will be higher than an acceptable quick ratio. Both will be higher than an acceptable cash ratio. For example, a company may have a current ratio of 3.9, a quick ratio of 1.9, and a cash ratio of 0.94. All three may be considered healthy by analysts and investors, depending on the company. For example, this table, the company A balance sheet. Current ratio is 3.9, quick ratio 1.9, and cash ratio 0.94. So, next, importance of liquidity ratios. So, first is determine the ability to cover short-term obligations. Liquidity ratios are important to investors and creators to determine if a company can cover their short-term obligations and to what degree. A ratio of 1 is better than a ratio of less than 1, but it is not ideal. Creditors and investors like to see higher liquidity ratios such as 2 or 3. The higher the ratio is, the more likely a company is able to pay its short-term bills. A ratio of less than 1 means the company faces a negative working capital and can be experiencing a liquidity crisis. So next is determine creditworthiness. Creditors analyze liquidity ratios when deciding whether or not they should extend credit to a company. They want to be sure that the company they lend to has the ability to pay them back. Any hint of financial instability may disqualify a company from obtaining loans. So lastly, determine investment worthiness. For investors, they will analyze a company using liquidity ratios to ensure that a company is financially healthy and worthy of their investment. Working capital issues will put restraints on the rest of the business as well. A company needs to be able to pay its short-term bills with some leeway. Low liquidity ratios raise a red flag, but the higher, the better. It's only true to a certain extent. At some point, investors will question why companies' liquidity ratios are so high. Yes, a company with a liquidity ratio of 8.5 will be able to confidently pay its short-term bills. But investors may deem such a ratio excessive. An abnormally high ratio means the company holds a large amount of liquid assets. For example, if a company's cash ratio was 8.5, investors and analysts may consider that too high. The company holds too much cash on hand, which is not earning anything more than the interest the bank offers to hold their cash. It can be argued that the company should allocate the cash amount towards other initiatives and investments that can achieve a higher return. With liquidity ratios, there is a balance between a company being able to safely cover its bills and improper capital allocation. Capital should be allocated in the best way to increase the value of the firm for shareholders. So let's proceed to the liquid assets. Liquid assets. A liquid assets is an asset that can easily be converted into cash in a short amount of time. Liquid assets generally tend to have liquid markets with high levels of demand and security. Liquid assets include things like cash, money market instrument, and marketable securities. Both individuals and businesses can be concerned with tracking liquid assets as a portion of their net worth. A company with more liquid assets has a greater capability of paying debt obligation as they become due. In terms of liquidity, cash is supreme since cash as legal tender is the ultimate goal. Assets can then be converted to cash in a short time are similar to cash itself because the assets holder can quickly and easily get cash in a transaction exchange. Liquid assets are often viewed as cash and likewise may be called cash equivalents because the owner is confident the assets can easily be exchanged for cash at any time. So overall, liquid assets are very important for individuals and businesses because they are the first source of cash used in meeting payment obligations. So, examples of liquid assets. So, examples of liquid assets held by both individuals and businesses include cash or currency. It will be the first example, cash or currency. The cash you physically have on hand. Next is bank accounts. The money in your checking account or saving accounts. Third, accounts receivable, the money owed to your business by your customers. Fourth, mutual funds, a fund that pulls money from many different investors into a diverse portfolio. And fifth, marketable equity securities or stocks. Equities may be sold on stock exchanges almost instantly, and publicly traded stocks are considered very liquid. You usually receive cash from the sale within a few days. As noted above, you may end up selling a security like stock for less than you paid for it. So, six, marketable debt securities or bonds. Some investors buy bonds and hold them to their maturity date, date. But the secondary market for trading bonds is vast, meaning that many types of bonds are relatively liquid investments. Like any security, you may end up selling bonds for less than you paid for them. So seven, treasury bills or treasury bonds or T-bills and T-bonds. They are highly stable and highly liquid investments backed by the full faith and credit of the United States government. As a consequence, they can instantly be sold for cash on the secondary market if you need their value before they mature. So lastly, exchange trade traded funds or E- ETFs are investment funds that trade like stocks on public exchanges, making them fairly easy to sell quickly. A liquid assets must have an established market in which enough buyers and sellers exist so that an asset can easily be converted to cash. The market price of the asset should also not be significantly changed, resulting in less, less liquidity or greater illiquidity for subsequent market participants. Not every asset you own can be categorized as a liquid asset. The basis of a liquid asset is that it can be converted into cash without losing value, while non-liquid items can be sold. They may lose a portion of their value if they are sold too quickly. It's also good to know what types of assets are not considered liquid. Generally, anything that would take some time to convert or to cash, or anything that could lose value in the process of doing so is considered illiquid. So, non-liquid assets. Non-liquid assets are assets that cannot be sold or converted into cash easily without a significant loss of investment. Examples of non-liquid assets. First is real estate. It can take weeks or months or even years to sell real estate. Collectibles like antiques, artwork, baseball cards, jewelry, and other collectibles can be difficult to value and hard to sell. Private equity. If you can invest in private equity assets like venture capital or funds of funds, you have the potential to achieve big gains. Intangible assets. Intangible assets are concepts or ideas that have value in such In some cases, a, a very great deal of value. Stock options. Many companies, not just tech startups, offer their employees stock option as part of a larger compensation package, equipment and vehicles. That would be the examples of non-liquid assets. So, what investments are considered liquid assets? Some some types of investments that are considered liquid assets are stocks, mutual funds, money market funds, and bonds. As we al- as we already mentioned, real estate is not considered liquid. So any investment properties you own are not classified as liquid assets. Selling a property can take a long time, and you might not necessarily get its market value back sell when you sell, especially if you are trying to do so quickly. So why is asset liquidity important? Liquidity is one of the key factors that determines success in the world of business. Liquid assets ensure a company's ability to meet its immediate financial obligation and operating expenses. In addition, the assets serve as the company's protection from unforeseen adverse events such as recession or a sudden decline in demand for the company's products or services. Finally, their presence directly improves the company's ability to seek additional financing. Liquidity is important in case of financial emergency. When you encounter hardship, you won't necessarily have time to go through the process of putting your house on the market or selling your collection of rare artwork. You will need quick access to funds so you can pay for your essentials and stay on top of your bills. In a dire financial situation, it doesn't matter what your net worth is or how wealthy you are on paper, what matters is whether or not you have funds that you can get immediate access to. Example, when you're applying for a mortgage, your lender will likely consider this exact situation. They will verify the assets you own and how liquid they are, and determine if you have enough easily accessible money in reserve to cover your mortgage payments if you were to encounter a temporary financial hardships. Ultimately, having a sufficient source of liquid assets is an important part of having a healthy financial profile. We generally cannot anticipate hardships such as such as losing a job or developing a debilitating illness. Having cash ready to go in the event of a financial crisis will make getting through it a little more manageable and give you some peace of mind. If you don't have anymore, enough or any money set aside in an emergency fund, take a survey of your assets. If you have a high amount of illiquid assets trying up your money, consider liquidating some of them to finance your emergency fund. If you don't have illiquid assets you can or want to illiquidate, aim to set aside at least a portion of your paycheck to grow your emergency fund. The term liquid asset is most often used when talking about investments in a stock market. So liquid assets are those that have a really full of buyers willing to pay market price, the market price. In contrast, illiquid assets are those with few buyers. With an illiquid assets, the owner may have to wait a while to find a buyer willing to purchase the asset. Many penny stocks, for instance, are illiquid assets because they are not as quickly bought or sold as higher value stocks. So, thank you for your listening my discussion this day. Good day and God bless us all.